Hello traders, welcome to a new video. Quick disclaimer, and as always I have it on all my video descriptions. None of this constitutes financial advice. This is just for educational and entertainment purposes only. So today I got a very special video for you. I actually did a few weeks ago an update on my day trading course with order flow and volume profile. All my courses are consistently getting updated, as well as I give continuous support to all the students in the free Discord that's included with the courses as well. We have a great community there. And so on my last update that I did a few weeks ago, I went in depth regarding volume and liquidity in trading, and how by understanding these concepts, you're going to have a better idea of how markets move. Okay, so I'm going to do, I decided, this was a very important topic, and I know many of my followers on YouTube are always asking for more order flow content. So I'm going to make sort of a summary of the update that I made on my trading course, just going over some of the highlights to understand these concepts. Okay, so first let's go over two quick definitions. Volume is the volume of trade, refers to the total number of shares or contracts exchanged between buyers and sellers during a period of time. The volume of a trade is a measure of the market's activity and liquidity during a set period of time. Higher trading volumes are considered more positive than lower trading volumes because they mean more liquidity and better order execution. And then liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. The most liquid asset of all is cash itself, because obviously cash is already cash and you can transact very easily in cash, where if you're dealing with like checks, cards, etc., obviously there's a middleman in the bank, etc., whereas cash is the most liquid asset there is. And the more liquid asset is, the easier and more efficient it is to turn it back into cash. Less liquid assets take more time and may have a higher cost. So obviously, if you're traveling and you have US dollars, it's going to be a lot easier to convert US dollars to whatever local currency you need in a different country than it would be if you had, Chinese yuans, or if you had like a country from, Mexican pesos, etc., So cash is always the most liquid and the easiest access asset to transact with. Okay? But then the basic concept is volume is a measure of how much trading activity, how much shares or contracts are being bought or sold in a market. And liquidity refers to how much available orders there is, how easy it is to transact in different markets. So I've had videos on this and I go in depth on this as well on my course, but there's two main tools that you can use in order flow in order to analyze liquidity and volume. One is going to be the DOM, and the next one is going to be what's called heat maps or book maps. So I'm just briefly going to go over a very quick explanation of this and how we can use them in order to identify liquidities and volumes in markets. So this is a depth of market of the S&P 500. This is obviously a very old one. As you can see, this is from 2016, where the S&P was in the 2000s. This is much more recent. We've been around the 4200s. But basically on a DOM, you have your price column right here, and then you have bid and asks. I've talked about this a lot on my videos regarding footprint charts here on YouTube as well. But bids are basically resting passive buyers, meaning these are resting orders to buy on the bid side, and these are resting orders to sell on the ask or the offer side. Okay, so we call them passive traders because they're just sitting here waiting at a specific price with their orders to get filled in order to go short or to go long. And then, as we've discussed before, you need aggressive traders that are going to be able to pay up to get filled in order to get long, or they're going to hit the bid in order to then get short, because as you know, for every buyer there's a seller, for every seller there's a buyer. So that means if someone is looking to buy long here, he has to be filled in by an aggressive market seller. Okay, so this is how we can see liquidity in a DOM, is by how much orders are resting. Now, these amounts are totally dynamic. If you look at this, especially, during a period of high trading activity, let's say at like 9:30, just after 9:30, when the US stock market opens, you're going to see the DOMs, and they're just going to be going crazy. There's numbers just going up and down. There's pulling and stacking. There's continuously orders being added and subtracted from different levels. There might be a huge number of orders to get short here because this is seen as an important resistance area. But then if the market is getting very aggressive, going up very fast, traders then may not be as confident and start pulling their orders. So then this will go down, etc. Okay? So basically, the higher the number of resting orders, the more liquidity or more liquid a market is. You can see here, this is probably from an extended trading hours, because you can see we got just depth of basically like on average like 60s on the bid and the ask, whereas here this is definitely regular market hours, where you can see we have depths on average of about 900 contracts on all the different tick levels here. Okay, so just we would say then that this DOM is a lot more liquid than this one, just because we have so much more orders in the book resting there. Okay, and what that means, the more amount of orders we have resting, this, you can look at this as if this is like friction. If you're like just to put some like analogy, let's say you're just like running, and if you're running and you're like running on just a little bit of grass, you're going to be running very fast. But if you're trying to run on very high grass, it's going to be a lot harder because there's a lot more friction to get to. Okay, sort of that analogy you can do with the DOM, where if you see a lot of contracts sitting on the bid and the ask, that means you're going to need a lot bigger size and a lot more aggressive traders to try to push through those orders and consume the book in order to get market to move. And similarly, if you're trading on a market that has very little liquidity sitting, if you just get a few high volume executions, then this market is just going to rip very fast, because the orders are just going to get consumed very quickly. Okay, and that's when you see very volatile markets. Okay, the next one, which I personally don't really use this a lot. I know of, I'm familiar with Bookmap and Jigsaw and the heat maps, etc. This is, as you can see right here, we have price, we have a DOM right here as well. We have the orders to limits to sell, limits to buy, prices right here. And what a heat map shows you is just a historical view of how liquidity has moved in the market. So you can see right here, this little graph here, it says the darker the color, the less orders there are. And then as we move into yellow, orange, red, the more red it is, the more number of orders are. Okay, so as you can see, this market, usually these graphs also use very, very low time frames. Usually these are like like maybe 10-second candles, sometimes 30 seconds, maybe 1 minute, but usually it's like 5 or 10 seconds, where all these bubbles that you see here are all the executed orders. The bigger the bubble, the bigger the orders executed, etc. And as you can see, market, let's say, was going up here, and then we had a big wall here at 29, 30, 75. We had a lot of liquidity, especially right in this area. You can see the dark red, but then market just started going down, and once market just pushed further down here, people started pulling orders, and you can see we got a little bit lighter blue here. Then market started pushing back up, and then you can see orders being stacked again here in the orange, and then the same thing, the market pulled back again, and you can see orders were being pulled, or not only pulled but moved down. You can see here we had red and yellow here, then suddenly this becomes blue and white, and now we have yellow one tick down at 29, 30, 50, then down here, then down here. So you can see the limit orders to sell, the liquidity was moving lower as the market was moving lower. And then you can see market pulls up here, comes up, it hit a big pocket of liquidity here on the orange levels at 29, 29, where it's sort of chugging now. And then you can see right here, there's more liquidity sitting up. Okay, and you can verify this here, for example, just by looking at the thickness of the order book. You can see like this cluster here, this 3 tick levels, all have orders into the 550s and 60s. Okay, so the heat map basically shows you a historical representation of where you had the most liquidity, which in this case is right here around all this orange areas right here. Okay, so this is just a visual way. Now, do you need to have heat map in order to do good order flow trading? Of course not. This is just an extra tool in your arsenal, but like I said, I personally don't use this in my trading, but it is a good confluence tool if you want to track liquidity in the markets. Okay, and now we're going to go over this very important matrix where we're going to talk about the 4 different scenarios. There's a few, there's all kinds of scenarios, but this is the 4 main scenarios that I've identified that I want to talk to you about. Okay, so first, let's talk about environments with high volume and low liquidity. When we have these environments, we're going to see big impulsive moves as just a few big orders can consume the available liquidity. Okay, and if we just move back to the DOM, it's exactly what I told you before. If you have a market with a very, what that's called a thin order book, and you can see in this case, this is the ES market, which always has one of the best liquidities of any market out there. But some markets even have some empty spots. Like if you're trying to trade, some kind of like unknown crypto and stuff, like there's just going to be some areas where there's literally going to be gaps where like no one is interested, and you're just going to have very few contracts. So imagine you have a market like this where all you have is 2 contracts here, 3 here, 9 here, 6 here, etc. you have very low liquidity. So if you suddenly get a big whale, a big aggressive buyer that just market buys 30 contracts, this is just going to shoot up and just eat through this entire levels right here. But then obviously that trader as well is going to get what is known as slippage, because they intended to get in at let's say the 42.2175 level where we're now, but since they had such a big order with little liquidity, they pushed the market up, let's say 4 points or 3 points. So now their average entry is going to be probably right around here, so they got slippage and they got an unfavorable execution because there was not enough liquidity in order to give him a nice tight entry. Okay, so markets with high volumes and low liquidity are going to be very impulsive. Okay, same thing when there's like big news events as well. Usually just before a news event, liquidity is going to be pulled out of the market because traders don't want to be positioned on the wrong side. So like if you're going to look at non-farm payrolls or Federal Reserve announcement, etc., as you're going to see, well, I'm going to show you some examples later, but you're going to see periods of very sideways action. And then as soon as the news hit, big volumes come in and liquidity hasn't yet filled the book. And then we get very choppy, impulsive action. Okay. Next scenario is low volumes and high liquidity. When we have these scenarios, then we're going to have small price movements because there's not enough aggressive participants with large size in order to consume the dense order book. Okay, so this is again the concept we talked before about friction. If we have a very thick order book like we have here, but volumes are very low, meaning buyers and sellers are very small. As you can see here, we're at 2158.50, and in order to push this market up one tick, we're going to have to execute 351 aggressive contracts to buy, meaning aggressive buyers need to lift the offer with 351 contracts at least. Same thing down below. If we want to move this one tick down, then we're going to need at least 877 contracts of aggressive selling hitting the book to move this market down. So if we don't have very large volumes traded, this market is just going to be sort of moving, within just a few ticks or not even really moving much until we get some higher volumes that can actually consume some of those resting orders. Next scenario is low volume, low liquidity. And again, this is a low volatility environment. This is also common, like I was talking about, right before news events when people are waiting for the data to hit. Usually traders are just anticipating, pulling orders. The order books are pretty thin. The market makers are, there's not a lot going on until the data hits. And then that's when the big executions and aggressive trading comes in. But when both environments, volume, liquidity are low, then we're just going to be having very little movement. Okay. And then finally, the last one is high volumes and high liquidity. And this is where you get moderate price movements. Like if you're trading something like ES or the NASDAQ, this is probably, most of the day is going to be right around this scenario, especially right at the open at 9:30, and for the next couple of hours, you're going to have high volumes, high liquidity on the book. This is where you're just going to get very nice, stable, trending movements. You know, you get your impulses, then you get retracements. This is more of, very controlled market movements where you have a lot of liquidity in the books, but you also have big traders as well putting in big aggressive orders, and that's where you're going to have a nice smooth movement in the markets. Okay, let's go into a few chart examples just to show sort of what I'm referring to when we're talking about the relationships between liquidity and volumes. So this is the S&P 500. This is a 1 minute chart, and this was right on the first Friday of September 2023, where we had NFP, non-farm payrolls, coming out at 8:30 a.m. Eastern. And so you can see here, we're coming on a low volume and low liquidity environment, because remember, this is taking place during extended trading hours. So the stock market is not yet open. So this is mostly just the European session going on. And as you can see, we have very little movement. Prices just moving within like a 4-tick range here. A 4-point range. And then right here at 8:30, huge infusion of volumes. And you can see within 1 minute, we had this candle that moved in between 45.23 and 45.44. So almost a 20-point range within a 20-minute candle. When the news hit, there was not a lot of liquidity in the market, and big volumes came in, and we just had a quick flush and a quick pump, and just a lot of the order book just getting cleaned up with a lot of volatility. And then once volume sort of started stabilizing, you can see that now we get just more regular movement here, and then a big infusion again of volumes right at the open at 9:30, and then we start getting some more controlled trending movements here. Okay, so when you have low liquidity, high volume, it is very choppy and unpredictable. When you have high liquidity and high volumes, this is when you're going to get more stable trends coming. Then let's compare extended trading hours versus regular trading hours in futures. So remember, extended hours, 6 p.m. Eastern into 9:30 a.m. Eastern the next day. Regular trading hours, 9:30 a.m. Eastern until 4 p.m., pretty much stock market hours. This is the NASDAQ 5-minute chart. And same thing, here we have the European session. We have some small trending movements, but you can see volumes are really low right at the beginning of the extended hours during the Asia session. Then at 3 a.m., London opens and Europe opens, and we get a little bit more volumes. But then at 9:30, when the stock market opens, we get a lot higher volumes. So you can see how volumes just keep increasing as the day progresses between Asia, Europe, and the American sessions. Okay? Then we have common gaps, which again, this is what we talked about. This is Bitcoin 1-hour chart. This was based off of ETF news that came out. And you can see same thing, Bitcoin last few weeks has just been very, sideways, just trapping traders within a range extremes. And in this case, we had very low volume, low liquidity environment. Then we had a big news headline hit, huge infusion of volumes, and just an impulsive move up here, which then usually this quick impulsive moves leaves what we know as a common gap here inefficient moves. We have a clear breakout level here, this broken resistance, and then you can see we come back and fill this movement back up here on some higher volumes into this move down. Okay, then we also have, this is euro US dollar 1 hour. There's a whole theory out there saying that markets are targeting your stops. Like we have very clear highs here, so then we expect a lot of, in this case, since people went short, they're gonna have buy stops resting right above this gray level right here, all this highs right here, and you can see market comes in and just taps right above this area, looking for basically where there's a lot of resting orders, because markets are always seeking areas of high volumes. Like I've talked about this, when we look at volume profile, the edges of the profile, the low volume node edges, usually these are areas, low volume nodes are areas of resistance or support where market rejects or moves very fast. Okay, but then the points of control, the areas with the most traded volumes, price tend to come and stick to these areas because they find acceptance from buyers and sellers. So if we were to make a profile here, it would look something like this, and you can see these extremes are just areas of very low volumes, but we come up here, tap just beyond these areas to seek out this liquidity sitting here. In this case, it was a failed breakout. We come right back in, okay? And then we tend to go back into the mean, into the point of control area, okay? So basically the whole concept of, stop hunting or seeking liquidity is traders usually will put stops beyond very obvious levels. So then, market is seeking areas where there's a lot of resting order flow. And in this case, we're going to have a lot of it just beyond this highs. And you can see we come and tap it. Sometimes these moves are, led by high volumes too, which means that this could be a true breakout. And then we could just, keep going from here. And then the last one, what we're talking about, the profile of seeking liquidity. This is NASDAQ daily chart. This is a long-term volume profile, and you can see marked off right here. This is the largest high volume node, and these two orange lines are the two main points of control, or the two price levels with the most traded volumes. And you can see how market goes on an impulse out, and then it just comes right back into this area. We pull down, we sink back into this area. Then we came down and we pushed right back into this area. And you can see on these levels, price tends to just churn around these areas because there's a lot of just volumes at these levels. So that's why I like to use points of control and profiles as good target areas, because market will tend to seek out liquidity or high volumes. Okay, so that's pretty much the scenarios of how markets move based on understanding the interactions of volume and liquidity. I hope this has been useful. Thank you all for tuning in. And if you like this content, make sure to subscribe, hit the thumbs up. If you want to learn much more in-depth strategies and concepts like this, check out my trading courses. This is just a fraction of all the concepts and things that I share on them, and all the information is in the link down below. Okay? Hope you have a great rest of your week, and I'll see you in the next video. Take care.